Now let us look at the last reading of study session 18, reading 67, investing in commodities. Under this LOS, we are going to explore the relationship between the spot price of the commodity and the expected future price. So if they are in contango, it indicates that future price is greater than spot price, and if the spot price is greater than future price, then it is called backwardation. We'll also look at the risk and returns associated with commodities investment. And finally, we look at the commodity index strategy as an active investment. So let us start with the relationship between spot and future. As we have said, the contango is a situation in which the future price is above spot price. This is because investors believe that the spot price will be higher in future. So mostly it occurs when a commodity's price is high and volatile. From an arbitrage free perspective, this situation is most common. The second situation is backwardation, in which the spot price is above the future price. In this situation, mostly producers want to hedge their position against the losses which could arise from the unexpected price declines. Historically, this has been a typical situation, and sometimes it refers to as normal backwardation, where the producers are hedging their position against unexpected losses. Now let us look at the sources of risk and return. The sources of risk would include: an investor can achieve a long exposure to commodity pricing through a derivative instrument by entering into a future or forward contract. If it is over the counter, it would be a forward contract. If it is trading in the exchange, it would be a future contract. So either of them will give them long exposure. Similarly, if the investor is buying a call option, again it will give a long exposure to the commodity, and if it is selling put option, that also gives a long exposure. There are certain commodities which cannot be purchased or stored for long term, so there the derivatives are useful. Another aspect is when the investor is planning to invest in precious metals, for example gold or silver, then it is more efficient for him to have a long position by some derivative instrument rather than purchasing and storing them for long term, because there will be safety issues etc. involved. So if the investor is going through derivative route, then there is no problem for storing or purchasing. At the same time, any fall in the commodity position is going to have causing losses for the investor. So that is a risk associated. Now let us look at the measurement of returns. It could be measured in terms of collateral yield, which is the return earned on the collateral which has been posted for margin call requirement. Suppose the investor is buying a commodity future, so initial margin has to be kept and there might be a collateral involved, so the return earned on the collateral is called collateral yield. And the price return is defined as the return earned due to change in the direction of spot price. So if the spot price moves up by a certain percentage, that is called as price return. The third return could be because of the roll yield. This is the return which is based on the gain or loss resulting from re-establishing position, which is called rolling the position when the contract expired. For example, if an investor was long in say wheat or gold for near month contract and he wishes to continue with the long position, at the end of the month he has to roll over. He has to sell the current month and buy next month contract, which is called rolling over to the next month. The roll yield will be positive when the market is in backwardation. That is, the spot price is more than future price, because the future price will rise and equal spot price at the expiry of the contract. If the roll yield is negative, then the market will be in contango. That is, future price is higher than the spot price, as the future price will fall and equals spot price at the expiry of the contract. Now let us move to the next concept, which is commodity index strategy as an active investment. See, commodity index strategy is an active investment, unlike the equity index, which is a passive investment, because here manager have to decide which maturities are to be used for contracts, so which gives them flexibility. In the case of commodity index strategy, the managers determine when to roll over the next new contract, and the managers are also required to match the portfolio weights based on the benchmark index. And finally, they tend to determine the best securities to put as the collateral. So due to all these considerations, this is understood as active investment.